Hi, welcome back. As promised, we're going to discuss the global space because US President Donald Trump and the Chinese President Xi Jinping have agreed to a truce on the trade war that has weighed very heavily on global equity markets for most of 2018. Not just that, there is some news coming in that Qatar would be withdrawing from the OPEC as of January 2019. What does all of this mean for the global setup? Bruno Vestriat of Lakefield Partners joins into our discussion. Bruno, thanks so much for joining us. There is a 90-day tariff ceasefire at the moment. So for now, trade hostilities have been suspended. But do you see the uncertainties continue? There are people who believe that it won't be easy to ease tensions between the two giants.
Yes, good morning. Well, indeed, I think a ceasefire is clearly not the end of the war yet. I think there's still a couple of very heavy outstanding items that need to be solved within 90 days, which is not a lot of time. At least the market knows that nothing much is going to change until then. And I think that has clearly an impact on the technology sector in the U.S., which will clearly have a bit of a relief rally on that news. Whether they will succeed or not, I think that's a political issue. Clearly, I think diplomacy on that level is going to be increased again. And hopefully, within 90 days, it will be clear and certain, because that's what the market is looking for in the end.
All right, so we live in hope for the next 90 days. Then let's hope, they come to some kind of understanding. But Bruno, what's your positioning now in terms of the global market setup? What's your view on the emerging markets in particular? And where does India fit in that emerging market, in that pecking order?
Well, I think 2019 could be clearly the year for the emerging markets, because there has been some gap between the growth and the equity prices, mainly caused by the currency evolution. So we believe that the emerging markets in general could be the most interesting place from the equity point of view for 2019, given the high growth and given the low valuation. As to India, I think the Indian market has an advantage or disadvantage, however you look at it, that it is one of the emerging markets with the highest technology weight. Clearly, that sector in the next few years is still going to benefit from a lot of growth. It needs to be seen in how far these stocks remain relatively attractively priced in order to be attractive to foreign investors. The bigger question on the negative side is whether the Fed's quantitative tightening is going to reduce the attractiveness and the inflow into emerging markets.
Okay, so the big story of 2019 could be flows into emerging markets. But I guess the fly in that ointment could be the resurgence of crude, right? Brent is back above $62 a barrel. And now we hear that Qatar will be withdrawing from the OPEC as of Jan. We have the OPEC meeting coming up as well. For a layman investor, how do you read into all of these, happenings?
Yeah, well, first of all, I think Qatar should not be overestimated as to the weight and the importance into the oil production. It is the 17th biggest oil producer, and sure, they have the third biggest proven oil gas reserve in the world. The consequences could be twofold. Either the control of OPEC as one bloc has already been quite diminished over the last few years, and that could indeed put some more downward pressure rather than upward pressure on the oil prices. On the other hand, it might be because of dissatisfaction with the current moves and decisions which are taken on the production. So it's a two-cutting sword that remains to be seen what the net effect is going to be. I think oil at this level is unsustainable. It's clearly not a demand issue. It's more a production issue. And this could be a sign that this production issue is going to be solved in the next few months, hence putting upward pressure on the oil.
All right. So you expect oil to head to what levels then?
That's very difficult to say. I think that remains to be seen on how the production evolves and also how demand evolves. I mean, if we go into a recession in a few countries, clearly oil demand is going to diminish. But I think there's a clear indication from the producing side that they want to have a higher oil price. And in the end, they control a lot of that in the current situation.
So we'll wait by then, and we'll see what kind of an outcome we get later this week. But talking about emerging markets, how does China fit into this space? It's been the big underperforming market. It's at, a couple of year lows is what we have seen. This year itself, that market's lost 20%, just in this year, 2018. What's the view on the Chinese market on the whole?
Well, I think there were a couple of structural issues and structural changes on the political side, which I think will see their effect in 2019. It is clearly the desire of the government to keep the growth at the level it is. I think in the long run that is very unlikely because, the economy is outgrowing itself. So to keep that growth going is very unlikely. There's the promise of the Silk Road, I think, which should not be underestimated as an impact of the intra-Asian trade. So clearly, I think they will stabilize towards 2019, and we will see the full impact of these measures from the government somewhere in 2019. So that should be positive for the Chinese market.
Okay, on that note, we'll let you go. Bruno, as always, thanks for speaking with us on CNBC TV 18. So that's the word coming in. The big story of 2019 could be the rise in emerging markets, and 90 days may not be enough to solve the tensions between the US and China. Let's take a short break on that note. Still very flat for the markets, but lots happening in the mid-cap space. We'll come back and give you a snapshot on all of that. Stay with us.